Now today we're going to talk about how to trade U.S. large cap stocks. The Standard & Poor's 500 or the S&P 500 is one of the premier stock indices in the world. It's where many of the biggest, most influential companies in the U.S. live. It's also an insanely opportunistic playground for active traders. Welcome back to the Switch Markets YouTube channel. I'm Shane Vernier, head trading coach over at howtotrade.com. Since the COVID crash of March 2020, the S&P has basically been on a rocket ship straight up, and that's created a ton of ways for people to profit. Of course, you had to know how to trade it. Now in this video, I'm going to show you exactly how to trade the S&P 500 in a variety of ways, whether you're a total beginner or you've been trading for a while. I can't wait. Let's get it on. So first, what actually is the S&P 500? It's a stock index made up of 500 of the largest publicly traded companies in the United States. Names like Apple, Microsoft, Nvidia, Amazon, and JP Morgan. Think of it as a scoreboard for the overall U.S. stock market. When people say the market was up today, many times they're talking about the S&P 500. Instead of betting on just one stock, you're basically getting a slice of the 500 biggest. Let's talk about the main ways you can trade the S&P 500. Now for longer-term investors, the simplest route is just buying and holding ETFs or an index fund that tracks the S&P 500. You're not trying to outsmart the market, you're just owning the market. But if you're a trader and you want some leverage, there are three main tools on the table. You got futures contracts, options contracts, and contracts for difference, also known as CFDs. We're going to zoom in on two of the most popular leverage products, S&P 500 futures and S&P 500 CFDs. We're going to talk about how they work, why traders use them, and what you need to watch out for. All right, let's begin by looking at the CME S&P 500 E-mini futures. Now, as a futures contract, these have an expiration date. They've also got extensive margins. So let's go ahead and show you exactly where to find these and get started. So what you're going to want to do is head on over to the CME Group website. That is the exchange in which these are traded. Go ahead over to markets, give that a click, and right down to the S&P 500. Now, you'll see that there are going to be a few different products that you can pick. The E-mini S&P 500 futures is the deepest futures market in the world. So that's probably what you want to be trading. A lot of the others are a little bit nuanced. Now, when you go to this E-mini S&P 500, click on specs. There's a couple of things that I want to point out that you need to know if you're going to be trading S&P 500 contracts. Now, the first thing is the contract unit, $50 times the S&P 500 index. That means it's going to be a fairly expensive contract. You can see right there on outrights, you're looking at $12.50 a tick. Remember, a quarter point equals one tick. So if we go up a full point, that's going to be 4 ticks. $12.50 per tick per contract. So if you're trading 3s and 4s, you could be upward of $37.50 or $50 per tick. That is an important thing to keep in mind. The other thing that you need to keep in mind are margins. Now the margins on the E-mini S&P 500 futures, intraday margins, they're not that extensive. You're looking at probably $500 per contract. But where things get tricky is when you look at your maintenance margins on holding one through that market closure. Every day, the CME, the E-mini contracts, they close for about 40 minutes for settlement. So in order to hold it through that market closure, you're going to need significant capital. And right here, you can see it's about $21,000. And that's going to vary per your broker. These are just exchange guidelines that have sort of been handed out to this contract. So very important that you understand significant maintenance margins. That's one area where CFDs excel. We're going to talk about that in a second. So that is the most popular futures contract in the world, is the E-mini S&P 500. Now, if that's a little bit too expensive for you, sometimes you need to dial down the granularity. The other offering from the CME is a fantastic one. It's called the Micro E-mini S&P 500 futures. Now, the Micro E-mini is the same thing as your E-mini S&P. It's just a lot smaller. So when you go to contract specs, you're going to see it's only $5 times the S&P 500 index, which means it's about a tenth of the size. So right here, you're outright. A quarter index point is only $1.25. That is much more affordable for your average retail trader. It also allows you to trade several contracts at once and give you a real opportunity to do maybe some scaling in and scaling out, maybe some trailing stops, maybe some scalping with position potential. So I recommend this Micro E-mini S&P 500 futures contract. That's going to give you a chance potentially to take more positions contract-wise and still keep that tick value a little bit lower. Now the margins, that's the other reason why you would lean on the Micro E-minis. You'll see right here, your maintenance margins to hold these contracts through a market closure, be it the daily market closure or the weekend market closure, is going to be only about $2,100. That's affordable for a lot of retail traders. So you can definitely swing trade these things. You don't just have to be an intraday trader. Typically, intraday margins are somewhere down around $100 a contract. It just depends on your broker. So that is a good look at the two top futures contracts to be trading the S&P 500. You've got the regular E-mini S&P 500 futures, and then you've also got the micro E-mini S&P 500 futures. Okay, let's take a few trades here on your E-mini S&P 500 futures. Couple things to remember about futures contracts. The first thing is you have to get the right symbol. So on TradingView, all you do is give that a click, and you're going to be looking at ES. You can see right here, here's your E-mini S&P 500 futures, and you go ahead and hit that arrow down, and you've got that front month contract. That's what everybody's trading. That's where the liquidity is. In this case, we're going to go ahead and be trading the December contract 2025, and that's going to be our futures contract. Now, when we trade futures, it's relatively straightforward. It's easy. There's a couple of ways to place the trades. A lot of folks have chart traders where you can just enter orders right there on the charts. A lot of folks, they have a sort of an order entry platform similar to this, or you can just go ahead and use the trading dome. Over the years, I have pretty much always used a depth of market, and you can just enter your limit orders there, or you can enter market orders, whatever you may need to do. The great thing about futures is you make money from buying or selling. So let's say that we want to execute a buy right here on this E-mini S&P 500 futures contract. Let's say I want to go on the market. So we've got how many contracts? Let's go ahead and trade 4 contracts here. That's going to be a big trade. That's going to be about $50 a tick. Let's go ahead and buy the market and see what happens. So we're officially long, and you can see right here, we're down 50. We'll probably rotate maybe up 50. But every time the market moves a tick, we are going to be essentially either credited or debited $50. You can see right here, we're sort of taking it a little bit on the chin, but that's okay. The market typically is not volatile this time of day. We're going into that Japanese Open, which, you know, I mean, it's not a bad time to be trading, but I would definitely be looking to do this during the U.S. Open. But you can see right now the market's gone against us 4 ticks. Remember, we're long. We definitely want to make money from the market going up in this case. Right now, okay, so we're back to break even. Let's see if we break positive here. It looks like, nope, we're going to go down about 4 ticks. So that essentially is the game. We make money when we buy the futures contract, when the market moves up, when price rises. Now, one of the great things about these contracts, you can profit from short selling just like you can go long. What does it look like? It's easy. All you do is you go over here. Let's say I want to sell the market. Let's go ahead and sell the market right there. Now I'm going to profit from the price actually falling. It's that simple. So I can have profit targets. I can look at my take profit down in here. I can look at my stop loss up in here. Just remember, those margin requirements are huge. If we were going to actually put a swing trade on like that with just 4 contracts, you can see exactly how big these values get. That's the one thing I would really stress about futures. It takes a lot of money to take that trade. It takes probably even more money to hold that trade. As you can see, we just went a few ticks and we're up a few $100 there, or $100. So that essentially is it. That is how you trade the E-mini S&P 500 futures. Focus on when the market's at its most liquid and volatile, no matter what your approach is. Typically, you're going to want to do that during the U.S. session. But remember, you can buy the market. You can make money from rising prices. You can sell the market and make money from falling prices. But the significance of these futures contracts is, yes, they do expire. They do close every day. And they take a lot more margin money to trade, especially if you want to hold it through a market break. So something to think about there if you're trading this ES contract, and that's full-size E-mini S&P 500 futures. The market works exactly the same way on the micro contract. It's just much, much smaller. The values aren't nearly as high. Okay, let's talk a little bit about S&P 500 CFDs. Now, a contract for difference is a lot like a futures contract, except there is no expiration date. You can still buy and sell, profit from either price fluctuation, but it is a little bit easier to trade CFDs as opposed to futures contracts. So let's go ahead and head on over to Switch Markets. Thousands of markets over here. Let's go ahead and find our indices. Go right up to Markets, give indices a click, and you'll see right away, you're going to cursor down to the major financial indices, and one of the biggest right there is going to be the S&P 500. So there it is. That's the S&P 500 CFD. The biggest thing to remember when you're talking about trading the indices with a CFD product is you're going to get a credible leverage. You can see right here, fast order execution, leverage up to 1 to 200. That's about a 0.5%. Now, in the United States, for those futures contracts, you're looking more at about 5%. You're going to need 5% margin on the notional value of the contract. Don't worry about that. Just remember, 5% per contract or a 0.5% per contract. That's getting you more bang for your buck and the ability to take larger positions and maximize your capital efficiency with a CFD. Another great thing about the CFD market is you don't have those market closures every day. So we're gonna sum that up here for you at the end of the video, but this is a good look at that S&P 500. Now, one of the biggest problems or challenges that a lot of folks have that trade CFDs is they don't like spreads. They say, I'd rather trade futures because there really isn't any spread at all. The E-mini S&P 500 is very, very liquid, but you have to pay a commission to play it. Over here, you're going to deal with a spread. There's the US 500 or S&P 500 index, and look at that spread, 0.7 of a pip. It's not even 1 pip. So that's a good look at where to find the S&P 500 CFD over at Switch Markets. All right, let's get in there and show you exactly how to execute a trade on this S&P 500 CFD. So we've got MT5 pulled up. Remember, you're looking for the symbol US 500. That is the S&P 500 CFD product. So what we have here is a few indicators on the chart. You can make money when price rises or when it falls. Let's show you how to take a long trade on this CFD contract. So right up here, we've got our single click trading. Right click on your charts, one click trading, pops it right up. Let's take a little bit of a leverage trade. Let's go ahead and trade 15 lots here. And what we want to do is let's go ahead and just buy the market. We think the price is going to rise. Let's go ahead and give it a buy. Okay, we're officially long. And as long as price keeps going up, we're going to be in pretty good shape. Now, right now, the spread, a little bit bigger than normal. Not really too big, but we're sort of going into that Tokyo Open. It's not the U.S. Open. Market's not quite as liquid. Always remember that you want to trade this type of product when you're at your most liquid. Typically, the U.S. 500, it's going to be during that U.S. Open, early U.S. session. So you can see right here, we've taken the long. We're sort of right around break even. Remember, with your drag and drop functionality here on MT5, you can go ahead and drag your take profit up here, and maybe you can drag your stop loss down here. So as long as price rises, you're going to make money from this position. Go ahead and close that out. You can just hit the X there, and that'll go ahead and close your trade. Now, remember, on a CFD, you can make money from price falling just as easy as you can from it rising. You can see right there a fantastic move earlier in the session. That was during the U.S. session, really a nice sell-off. You could have made a significant sum there. Let's go ahead and show you how to get short on this market. The first thing you want to do is go up to your one-click trader. Let's say I believe price is going to fall. Let's go ahead and click sell. We're officially short the market. So as the market moves down, we are going to make money now. And how do you align this? Your take profit is going to be beneath price action because we are short, and your stop loss is going to be above price action because that's going to be where we get out of the market if it is to rally. That's all there is to it. You can make money going long or short on this US 500 CFD on your MT5 platform. So be nimble. Remember, it's important to trade this one when the market's active. Typically, you're going to want to look at maybe that U.S. session, maybe beginning an hour before the U.S. session, somewhere in there. That's when this market's liquid, and that's when it's going to be moving. Simple as that, though. Make money two ways: rising prices or falling prices, incredible strategic flexibility. So which is better, futures or CFDs? For a lot of active traders, CFDs have the edge for a few reasons. First, they're more flexible. You can fine-tune your position size instead of being stuck with a big fixed futures contract. Number two, they have low barriers to entry. Usually, you need less capital up front thanks to the built-in leverage. Number three, they have no expiration date, with no contract rollovers, and there's no worrying about expiry dates. And number four, they're easy to go short. Buying and selling works the same way in both directions. This is true with futures, but the reduced leverage make it easier to short the market with CFDs. Now remember, CFDs are powerful tools as long as you respect the leverage. Now, if you're looking to cash in on the opportunities in the S&P 500, CFDs with Switch Markets give you a fast, flexible way to do it. You can go long or short. You can trade intraday or swing. It doesn't matter. All right, hit up the platform and check out our CFD lineup. There's literally thousands of products with multiple ways to get exposure to the S&P 500 and the stocks that drive it. Don't forget to like, subscribe, turn on your notifications, and we'll catch you on the next one.